Okay, so imagine this. You're looking at a company, maybe thinking about investing, or you just want to, really understand if it's healthy. You grab their latest annual report, hoping for some clarity. But what do you usually find?
Well, often it's just a wall of numbers.
Yeah.
Right? Dense financial statements.
Exactly. And you're left wondering, what's the real story here? What are their actual plans? How do they handle risk? What makes them tick beyond the balance sheet? So today, we're going to dig into something called integrated reporting, or IR.
Mm-hmm.
You can sort of think of it like a superpowered X-ray for organizations. It's been developed and pushed by the International Integrated Reporting Council, the IIRC.
Yeah, and that's a pretty broad coalition. Includes regulators, investors, the accounting profession.
Right. So our goal here is to unpack how IR gives you a much more complete, more holistic picture of how these organizations actually create value, not just financially, but like across their whole ecosystem. We'll look at how it ties together strategy, governance, performance, all in one concise communication.
And crucially, how it connects those financial results to the wider context, social, environmental, economic stuff.
Showing that bigger picture.
Exactly. And, this isn't just about ticking boxes. What's really fascinating, I think, is how IR pushes organizations to show the connectivity between things, between their strategic goals, the risks they face, their performance. It's about understanding how value gets created short, medium, and long term.
Moving beyond just the next quarter's results.
Absolutely. Which makes it a much, much better tool for decision-making, whether you're an investor or, any other stakeholder.
Okay, let's unpack that a bit more then. Why did we even need integrated reporting? What was wrong with the traditional reports for someone, say, trying to understand a company they know nothing about?
Well, the limitations were pretty significant, weren't they? You'd learn very little about their actual day-to-day business activities, who their competitors really are.
Yeah, or their future plans, how they plan to stay ahead, achieve that sustainable competitive edge.
Right. IR really aims to fill those pretty major gaps. And it's interesting because this thinking isn't entirely new, at least not internally. Management accounting, for instance, got criticized for years for being too inward-looking.
Okay.
But it evolved, right? It became more of a strategic partner inside companies, helping analyze, formulate, monitor strategy.
So helping internally look beyond just the number.
Precisely. So the question then becomes, if management accounting recognized this need internally ages ago, doesn't it just make sense that external reporting should catch up?
Yeah, that's logical.
And IR is in many ways that catching up. It helps make financial reports less of a backward look and more of a forward-looking roadmap.
That's a great way to think about it. So boiling it down, IR is this concise communication, strategy, governance, performance. And it explicitly shows the links between the money side and the wider world, impact, social, environmental, economic, showing value creation over time.
Short, medium, and long term. Yep.
Right. Okay. Now, the IRC guidelines mention several key content elements for an integrated report. Let's maybe walk through 6 of them that really help paint that full picture.
Good idea. Think of them as the key chapters in the company's story.
Right. So first up, the organizational overview and the external environment. This sounds like setting the scene.
It is. It's the foundation. What does the company actually do? Who are the key stakeholders? Employees, customers, investors, the community.
Where are they based? How are they structured?
And importantly, what's going on outside the company that could affect it? Big external events, trends. This is where you'd see things like their mission, objectives, maybe a pest analysis.
Looking at political, economic, social, technological factors.
Exactly. It gives you that essential universe before you dive into the specifics of the company itself. You need the lay of the land first.
Makes sense. The ACCA's integrated report, for example, they pointed to shifts like new economies emerging, more demand for financial stability after the recession.
Consumers getting savvier, more tech-focused.
And a broader competitive landscape because of technology, more international players. That really frames their world.
It does. Sets the stage perfectly.
Okay, so we've got the context. Next up, opportunities and risks. Looking at what could help or hinder them.
Right, and this covers both internal and external stuff. Traditionally, you might think opportunities and threats are just external, like in a SWOT analysis.
Yeah.
But IR stresses looking internally too. A weakness, like say, gaps in their product development pipeline, that's a risk to future revenue.
Sure. And a strength, like a really strong brand, creates opportunities.
Exactly. Now, historically, boards might, prefer to talk up the opportunities.
Understandably, perhaps.
Perhaps. But for anyone making a serious decision, like investing, you absolutely need to understand the risks involved.
You need the full picture.
You do. And while some risks can maybe be quantified, IR puts a lot of emphasis on a qualitative feel for both internal and external risks. And crucially, explaining how they're managing them, mitigating them.
So not just listing risks, but saying what they're doing about them.
Precisely. And honestly, if a company can't give you a clear sense of how they're handling something like, say, cybercrime risk, well, that should be a bit of a warning sign, shouldn't it?
Definitely. That transparency is key. The ACCA example you mentioned, their report did this well, right?
It did. They didn't just say cybercrime risk. They talked about market risks like trade protectionism, global economic slowdown, and operational risks like potential issues with their exam processes, the complexity of laws worldwide, and yes, cybercrime.
And they went into detail on cybercrime.
They did. They noted the potential impact corruption or loss of data, which could lead to legal trouble, reputational damage, big stuff.
And the mitigation.
Yeah, they spelled it out. Yeah. Having an information security officer, specific policies, regular reviews, monitoring, testing, that level of detail makes the risk and the response feel much more real.
Okay, that makes a lot of sense. So context set, risks understood. What's next? How does the company plan to actually move forward? Where do they put their money and effort?
And that leads us straight into strategy and resource allocation. This is about the how.
Right. How do they plan to get where they want to go? Are they developing new products, setting up new factories, expanding geographically?
Exactly. And this is where you might see them leveraging strategic models, maybe Porter's models for competitive analysis, or the BCG matrix for portfolio stuff, or the value chain.
So connecting the strategy to recognized frameworks.
Yes, showing how they're thinking strategically. And for you as someone looking in, it's really valuable to know how they plan to react to market changes, what these strategies might cost, and importantly, how they plan to manage the changes effectively.
Got it. And that brings us to, I guess, the core of it all, the business model.
You could say that. It's really the engine room, how the organization actually creates value.
The IIRC has a definition for this, right?
They do. It's system of transforming inputs through its business activities into outputs and outcomes that aims to fulfill the organization's strategic purposes and create value over the short, medium, and long term.
Okay, bit of a mouthful, but the key is transforming inputs into outputs and outcomes.
Exactly. And this is where those performance management models, like the value chain we mentioned, really come into their own. They map it out. Inputs, processes, outputs.
Yeah.
But IR adds that crucial layer of outcomes. What's the actual impact?
So not just we made electric cars, but maybe our cars contributed to cleaner air in cities.
Precisely. That's the outcome. And if a company doesn't really grasp its own business model in that full sense, inputs, activities, outputs, and outcomes, well, you have to wonder if they're just operating on luck.
And how sustainable is that?
Not very, you'd think. Their chance of continued success must be lower.
So let's break down those components. Inputs, that's like raw materials, people, tech.
Yep. Resources they use, then business activities. That's not just making stuff, right?
No, it's how they innovate, how they market, their after-sales service, delivery, how they hire and train people.
Okay.
The doing part.
Right. And then outputs are the actual products and services that result.
And things like business process reengineering or value-based management, activity-based management, these are tools that can shape that business model.
Absolutely. They're ways organizations refine how they do things to create value more effectively.
The ACCA report you mentioned, did it illustrate its business model?
It did, quite well, actually. Key resources were things like their offer is people, brand, IT, money.
Standard inputs.
Pretty much. Key activities included building global networks, qualifying accountants to high standards, maintaining their brand.
The core of what they do.
Exactly.
Yeah.
Outputs were things like qualified, ethical accountants, their products and services.
Okay.
And then the outcomes supporting their members, enabling people to work globally. And they even connected it to a wider societal benefit, that businesses run better, more responsibly, which helps economies grow sustainably. That's connecting their model to a bigger purpose.
That's a powerful connection. Okay, moving on. Performance. This seems straightforward. How did they do?
Essentially, yes. How did they perform against the strategy they laid out? What were the key outcomes?
And outcomes can be internal, like cash flow, or external, like customer satisfaction, brand loyalty.
Or environmental impacts, positive or negative. And it's really vital here that organizations pick the right performance indicators, ones that meaningfully track their strategic goals.
Not just vanity metrics.
No. And it also really highlights the importance of reporting on non-financial results, the qualitative stuff, which often drives long-term value more than the pure numbers.
Right. So after looking back at performance, the final piece seems to be looking forward, future outlook.
Exactly. Wrapping it up by addressing the question, what challenges and uncertainties might they face trying to execute their strategy? And what could that mean for their business model and future performance?
So peering into the crystal ball a bit.
Well, informed peering. This is where tools like PS analysis or Porter's 5 forces come back in, but used to anticipate future challenges and opportunities.
Yeah.
Think about it if you were, say, a stakeholder in a traditional TV company a few years back.
Yeah.
You'd absolutely want to see in detail how they plan to deal with the rise of internet streaming giants like Netflix, right?
Definitely. You'd want to know their plan for survival, adaptation.
Exactly. That's what the future outlook section should give you a sense of their resilience and how they're thinking ahead.
Okay. So pulling this all together, what's the big takeaway here? Integrated reporting sounds like more than just a new format for reports.
Yeah, it absolutely is. It's a fundamental shift, really, in how organizations communicate their true value and impact.
Moving beyond just the financials.
Way beyond. Getting that complete, interconnected picture. Strategy, governance, performance, risks, opportunities, future viability, the whole package. It's like seeing the architect's plans, watching the construction, and understanding the long-term vision for a building, not just glancing at the finished front door.
And it feels like, as you said earlier, external reporting is finally catching up.
It really is. Catching up to the kind of deep, holistic analysis that, frankly, good management accountants have been doing internally for years. It just hammers home that there's so much more to judging a company than just its profit and loss statement.
So as you, our listener, go about your day, maybe think about a company you deal with or even where you work. How could applying these IR principles give you a deeper understanding, a more holistic view of its value, its risks, its potential? What questions would you ask that go beyond just the numbers if you had that kind of integrated view? Something to think about.